All right, so this is the 2015 Leaving Cert question 8, and it's a stock valuation and flexible budgeting. And that would have thrown some people off. Obviously, flexible budgeting generally comes up in question 9. So again, there's an importance in not over specialising in the question 8s and question 9s in this. So stock valuation first. This is probably the quickest thing on the Leaving Cert. What we need to do is work out these sums here. So work out the purchases on credit, the total value of that, the total value of credit sales and cash sales added together, the total value of opening stock, and we also have to work out how many units were in each of those. When we do that, we can work out what the closing stock is. So I'm going to go with the purchases first. All right. So we've got 4,500 units by 6. We've got 2,400 units by 7. We've got 1,400 by 6. And we've got 2,600 by 8. Now, the total units then, add those together, that's going to be important. The total units is 10,900. Now obviously I can do this much quicker than you'll be able to do it. You'll actually have to use your calculators. I'm just going to multiply them out. So 4,500 by 6 is 27,000. 2,400 by 7 is 16,800. 1,400 by 6 is 8,400. And then 2,600 by 8 is 20,800. So your total purchases for our trading profit and loss account purposes is going to be 73,000. Right? Now I'm going to do my opening stock next, because the reason being I'm going to use these numbers in a minute to find my closing stock. So my opening stock is 5,200 by €6 per unit is 5,200 by 6, 31,200. Okay, so that's going to be important for my opening stock. All right. So my sales is next. So I'm going to do the same thing. Credit sales and cash sales. I'm going to work out all these numbers that are given here. So 1,200 by 10 is obviously 12,000. 2,200 by 11, 1,400 by 10, and 1,600 by 11. And I'm going to multiply all those out. And again, I'm going to total them. Total my units, 6,400, and total my euros, 67,800. Okay, I'm going to do the same for my credit sales. So that was my credit sales. I'm going to do the same for my cash sales. 1,100 by 11. 1,400 by 12. 1,600 by 13. And 1,100 by 13. Just multiply them out and of course just add them up. So that's 64,000. And my units was 5,200. So what do we do then? Obviously, the total sales then, units wise, 6,400 plus 5,200 is 11,600, and euros wise 67,800 plus 64 is 131,800. Now, we have to work out how many closing stock we have in units. So we have to see what stock we've left over. So if you think about it, the stock you bought minus the stock you sold is the stock that you've left. So you've got your opening stock, in units, which is 5,200. Your purchases in units is 10,900. So that's the amount you had available for sale. So that'll give you up to, what's that, 16,100. And you've got your sales in units, which we worked out to be 11,600. So we had 5,200 plus 10,900 available to sell, which is 16,100. We sold 11,600 of them. That means you had a closing stock available of 4,500. So that's 4,500 units of closing stock. So we now know the number of units of closing stock we have. We have to value them. So the value of closing stock, this is part one. So all of that stuff we did was just workings. So the value of the closing stock is valued on a first in, first out basis. So whatever we sell, whatever we have, we're going to sell first. Okay, so that 4,500, we have to compare that to, we have to basically assume that we bought those last. So they're the last ones we bought. So if we go back up here, the 4,500, 2,600, we still have 1,400, we still have, and then some of this 2,400 we still have. So we still have some of the 2,600, and we still have all of the 2,600 at 8, because that's more than or less than 5,200. We still have 1,400 at 6, because that brings us up to 4,000. And if we've got 5,200, well then we still have 1,200 of the ones that we bought at 7 left over. So we work back upwards till we get to 5,200. So this adds up to 5,200. See that? So you work backwards, all of the 2,600, all of the 1,400, and the balance left over is 1,200 of the 2,400 that we had left. Okay, so you just multiply them out. Okay, and then just total them. And that gives you your value of closing stock. So now we have a value of opening stock, we have value of purchases, value of sales, value of closing stock. Of course, we can do a trading profit and loss account, which is what the question asks for. Okay, so that's going to be made up of our sales. Now we know what our sales figure is. Our total sales figure is 131,800. Okay, less cost of sales. We've got opening stock. And we know our opening stock is up here, I worked it out, 31.2. Now, just if I was doing this in my Leaving Cert, I would have this trading profit and loss account filled out, you know, as a skeleton. And as I'm doing my workings, I'll be throwing the numbers in so I don't have to go and look at them, so I can save a few. I know it would only save you probably 30 seconds, but it's just so you don't have to go looking. The purchases then, 73,000, less the closing stock, of the 37.6, one we just worked out. That gives you a cost of sales of 66.6, which you'll take away to get our gross profit. Now, not ignoring the theory, what are the implications of an incorrect stock valuation? Well, if you think about it, if you have the stock wrong, the financial records or the financial statements, so trading profit and loss accounts and balance sheets, they'll be incorrect. And obviously if you've closing stock wrong, then you're going to have opening stock wrong for the following year, so they'll be incorrect for at least 2 years. So the closing stock and the opening stock of the following year. What can we say is going to be wrong? Or we can say cost of sales, gross profit, net profit will be under or overstated. Where's closing stock important? Well, it's in the balance sheet. So in the balance sheet, from the balance sheet, you like to conduct ratio analysis. Ratio analysis for liquidity ratios will be incorrect. I don't know how many marks are going for, but I'd be very happy that I'll be getting full marks for all of that. I'm sure it's not more than 4 or 6 marks. So just know, obviously, if your closing stock is wrong, then in accounting purposes, you have 2 years accounts wrong. You're going to under or overstate at least 3 numbers: cost of sales, well, you will, cost of sales, gross profit, and net profit. And then in the balance sheet, you won't be able to conduct accurate ratio analysis. Okay, so that's that. Part B then is your flexible budget. So it's only 2 things, nice and easy. So it says separate production overheads and other overheads into their fixed and variable element. So we'll do our production overheads first, and then when we're separating them into the fixed and variable element, we use the high-low method, units in euros. This is just simultaneous equations, as you know. So the high number of units, now I'm going to pick, sure, it doesn't matter what you pick. I'll pick 28,500 and 21,000, so I'll go with the high and the low, right? 28,500, 21,000. You pick any 2 levels. The cost of production overheads at those are 140, 400. And 140, 400 and 106, 800. So we'll just take those away from each other. And then we're going to divide them into each other to find the variable cost per unit. So 33.6 divided by 7.5. And you get 448 per unit. Okay, so I need to find the fixed cost then. So I'm going to transfer that 448 in. So my total cost is, I'll take the high one, 140, 400. And I'm going to have to take away 28,500 units by 448. And that'll give me, cheated here, that'll give me 12,720 as my fixed cost. Okay, I'm going to do the same for other overheads. I'll go units in euros, high and low. So I'll still use the 28.5 for my high, 21,000 for my low, given a difference of 7.5. And for my other, I've got 95.8 for the high. I'm just taking the high amount here, 95.8. The low is 71.8. So the difference then is 24,000. So just divide them into each other. So the variable cost per unit is going to be 24,000 divided by 7.5, which is €3.20. Okay, the fixed cost then, same process. We're going to take the high number, or either of the two numbers, doesn't matter. I'll actually take the low number this time, 71,800, and we're going to take away from that the low units, 21,000 by 320. And that'll give you 4,600 as your fixed cost. Okay, so that's separating them out. Now, we're asked then to prepare a flexible budget for 90%. Right, so I just want to work out what the units are at 90%. So if the units are at 70% is 21,000. There's a few different ways you can do this, but I just wouldn't mind working out what the units are anyway. So it's 90%. So if we take this 21,000 is at 70%, divide that by 70, multiply by 90, that'll give you the 90%. So the 27,000 is going to be the units at 90%. So we're asked to do a flexible budget using marginal costing principles, right? Marginal costing principles is sales minus variable costs equals contribution per unit. Contribution per unit minus fixed costs equal profit. Right, so sales. So no, it doesn't give us a profit is 20% of sales, so it doesn't give us the sales price. We're going to work that out later. We can work it out now. So the total cost, well, I'll work it out later. So the costs then, so my variable costs first. So my variable costs, right, I've got my direct labour. Now, I can just take that 315 and I can divide by 70 and multiply by 90 because they're fixed amounts. Okay, or you can take the 315 divided by 70 and work out what it is per unit, and then multiply that answer by 27,000 because 27,000 is the number of units. So I'm going to do it that way. So I'll just go 315 and I'm going to divide that by 21,000 and that gives me €15 per unit. So I'm going to go multiply 15 by 27,000. Okay, I'm going to do the same for my direct materials. I'm going to do the same for direct labour. So direct labour is 231,000. If I divide that by the number of units, keep dividing by 21,000, I'll get 11. So it's 11 per unit, and I'm going to multiply that by 27,000. Okay. Now then I've got my production overheads. Now I know that my production overheads per unit are 448. So I'm going to go 4.48 by 27,000. And my other overheads then are 320. So I worked that out earlier by 27,000. So my total is 909,360. Now, I'm going to just put in a line here of contribution, and we work that out after, okay? So then I'm going to take away from my contribution my fixed costs. Now my fixed costs, again, I've got production, which I worked out in my first part, that my production fixed cost was 12,720. I've got my other, which I worked out in my first part, was 4,600. Then I've got up my admin from the question, which we can take is fixed. Well, it is fixed. It's 35,000 each one, so that's 35,000. So my total fixed costs are 52,320. So I'm just going to come down a little bit, right? And my total costs then are 909,360 plus 52,320. Which is 961,680. Now, if my costs are profit is budgeted to be 20% of sales, right? So my costs must be 80% of sales. So this is a bit like your incomplete record. So 100% or sales must be 961,680. Divide that by 80 and multiply by 100, and that'll give you your sales. Make that a little bit bigger. So that's 120 to 100. So my sales are going to be 120 to 100. Then from there, if I take away my variable costs, you get your contribution. Just remember, it asks you to do marginal costing. So marginal costing is sales minus variable costs is contribution, and contribution minus fixed costs is net profit. All right, part 3 then. Explain what a controllable cost is and uncontrollable cost is. So a controllable cost is one that can be managed by the manager of a cost center. So basically, the manager decides the level of the cost. So the manager decides, in effect, wages, materials purchased, anything like that. So all variable costs, such as materials, wages, etc., are controllable. So you can decide how many staff you hire, so that's controllable. You can decide how many kilos of a unit you're going to make, so that's a controllable. A non-controllable cost is something you can't be held responsible for. So it is one the manager of a cost center is not held responsible for. They're nearly always fixed costs. So any changes are decided by someone else. So examples would be, the best example I suppose is rates. or insurance be another one. Okay, where the insurance company decide the amount, the cost of your insurance for the year based on the risk that you have. Okay, so that's that one done. Hopefully that one's all right. It's a fairly straightforward question. As I said, if back in the day, if you decided you were only going to do costing, that would have been a struggle for you because you might have left out flexible budgeting. However, if you decided you're only going to do budgeting, it might have been very, very easy one to do because the stock valuation is so straightforward. All right, we'll talk to you again.